oil prices are like the pulse of the global economy because oil is used in many industries, transport, manufacturing, even agriculture. So when oil prices move, everything else moves with it. Let's say prices go up. Well, transporting goods becomes more expensive and that cost gets passed on to us whether we're buying groceries or electronics. In simple terms, higher oil prices can make everyday life more expensive. But it doesn't stop there. Rising oil prices often pushes inflation up, and inflation rises, central banks might raise interest rates to cool things down. Suddenly, your loans, your mortgages and EMIs becomes more expensive. On the flip side, when oil prices drop, it's usually good news for businesses. Lower cost means higher profits, but for countries that rely on oil exports, a price drop can hit hard, which can cause economic instability on a larger scale. So in a nutshell, whether we realize it or not, oil prices influence everything from the price of a morning coffee to the stock market. Now, oil prices move based on the classic principles of supply and demand, but there's a lot more nuance to it. Here's how it works. Now, oil production is controlled by a few key players like OPEC and major oil-producing countries like the US, the Russia, and the Saudi Arabia. Now, when these countries decide to pump more oil, the supply increases, and if demand doesn't change, prices usually drop. On the other hand, if they cut production, supply tightens, and prices can shoot up. Now, the demand for oil depends on also global economic activity. When economies are booming, industries need more oil for manufacturing, transport, energy, pushing prices up. Conversely, during recession, demand drops and so does prices. Now, conflicts or political instability in major oil-producing regions can also trigger price spikes. For example, if there's unrest in the Middle East, traders worry about supply disruptions, which drives prices up due to fear of shortages. Now, coming to the current story. As seen in the last 2 years, oil prices can rise as quickly as they can fall, both unexpectedly and abruptly. Now, due to the Russia-Ukraine war, oil prices rose to more than $120 per barrel. Now, on weak demand concerns due to global growth slowing, it later fell to $70 per barrel. Naturally, this led to major oil-producing countries reducing their output in an attempt to drive up prices. Then the Israel-Hamas conflict led to the rise in crude oil prices. Now, when tensions arise in such oil-producing regions, as we just discussed, it can lead to problems with crude oil supplies, which leads to a rise in oil prices. But now crude oil prices are pressured on the downside once again. Now, why is this happening? Well, it comes down to a mix of concerns about both demand and rising supply. On the demand side, we're seeing a slowdown in major economies like the US and China, which means less oil is needed. And when the biggest players in the game, especially China, the world's largest crude importer, start using less oil, prices naturally fall. On top of that, we've got more oil coming out of countries like Libya, which adds to the global supply. Plus, OPEC is gearing up to increase production this October, which could push prices down even further. So there are several factors that are pressuring oil prices down. Now, what is the impact on India? For countries like India, which imports a lot of oil, this price drop is great news. Lower oil prices mean cheaper imports, which can help ease inflation and reduce the cost consumers face on everyday goods. Now, when crude oil prices drops, oil marketing companies, the ones responsible for refining and selling fuel like petrol and diesel, benefit. Because low crude oil prices reduce their input costs, meaning it costs them less to buy and refine the oil. Now, this gives them the flexibility to either pass some of the savings on to consumers or keep prices stable, allowing them to increase their profit margins. Now, similarly, paint manufacturers gain from lower crude prices too. Crude oil is a key ingredient in making chemicals like solvents, which are used in paint production. So when crude oil prices fall, their raw material cost drops, making it cheaper for them to produce paint. Now, this allows them to either price their products more competitively or boost their profits. However, on the other side of the coin, companies involved in oil drilling and exploration like ONGC and Oil India suffer. These companies make their money by selling the crude oil they extract, so when the prices fall, the revenues take a hit. Now, with lower selling prices and similar operating costs, their profit margins get squeezed, making it hard for them to maintain their profitability. Now, to wrap things up, while the drop in crude oil prices brings good news to India, we should keep in mind that these prices are likely to remain volatile. There are several factors such as economic slowdown, supply fluctuations, geopolitical tensions that contribute to this uncertainty. That's why it's never a good idea to base your investment decisions on short-term movements in oil prices or any other commodity. Now, the key is to focus on the bigger picture and take a long-term approach for investing. So stay patient and keep your eyes on the fundamentals. Having said that, this is me, Merlin Susanna, signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.